Hey folks, and welcome to the Pipnotic Symposium on the 11th of February 2020. Today we're going to talk about the concept of liquidity. First we're going to have a look at some slides, some theory, and then we're going to jump into the charts. Okay, first of all, what is liquidity? Well, liquidity is essentially the amount of whatever it is that is for sale. And you have high liquidity markets, and if you have something that's very liquid, it means that you can always find a counterparty for your trade. Okay, so the euro US dollar is a very good example of a very liquid market, in contrast to low liquid markets like vintage red wine. If I have a bottle of vintage red wine, I'm potentially not going to be able to find someone to buy my bottle instantly. So this will take a bit of legwork. And essentially, if I have a commodity that is very illiquid, my selling or my buying of this commodity can also affect the price of it. I mean, if you look at a price chart of something, I mean, price is not going to move up or down without the presence of willing buyers and sellers in the market. And this willing buying and selling is visible in the market in the form of the order books. So you have people who are willing to buy at low prices, people who are willing to sell at high prices. Essentially, the market will have to move up to these high prices before it can move down, and it has to move down to the low prices in order to move up. Okay, so essentially, I mean, higher prices are going to attract sellers and low prices are going to attract buyers, and anything in between these two extremes is pretty irrational, and as a trader, this is higher risk and lower probability. If you ask yourself the question, what is it that moves the price of, let's say, the American dollar, Japanese yen, filled orders or unfilled orders? If you look at a price chart, what you're seeing on the price chart, this is what has already happened. So the transactions have been made, the orders have been filled, so that's actually showing you what has already happened. What you're not seeing are the pending orders that are sitting in the market waiting to be filled. And this is key, because the price of a commodity, whatever it is, cannot move without the presence of willing buyers and willing sellers advertising prices they are willing to engage with in the market. Okay, and these are typically put in the form of pending orders. The presence of this advertised willing liquidity in the form of pending orders is what is going to move the price. Okay, if you look at a price chart, then you almost have to focus on the negative of a price chart, if that makes sense. So you see, let's actually go to a chart. So you have this here. So you have prices moved up and down, and this has already happened. This has already happened. But what you don't see is where we have these willing buyers and willing sellers in the market, and this is really important for us to understand. So let's have a quick look at liquidity, what this means. So I'll ask you a question here: would selling or buying 50,000 units of this commodity move the market more? Let's have a look. If you look here, this is the spot price for this commodity. Okay, and you can see here that we have big numbers, so we have thick liquidity below price, we have small numbers, thin liquidity above price. And let's just say that these are units of this commodity here. So we have 2,000 units per block here, and we have 10,000 units per block above price. So let's say I come in with my 50,000 unit order and I sell at market. What's going to happen? Well, that market order is going to move down here, and it is going to sit in this little pool of liquidity, and this pool of liquidity is actually going to consume my order. These are buy limits. I sell. The pending order here is actually going to fill 1/4 of this order, and it's going to completely consume mine. And so why did the price of this commodity not go down? Well, that's because someone else has to come and they have to sell 3 times what I sold in order to bring the price down 1, let's say, pip. On the other hand, if someone comes in and they're looking to buy, they come in with their 50,000 unit and they buy, so they buy at market. We have these sell orders here. What's going to happen here? We're going to consume this one, this one, this one, this one, and this one. So price is actually going to move up 5 pips before my order is filled. This is also known as slippage. Okay, so when you have an order, you want to buy, and your buying moves the market, that's because there's not enough liquidity on the opposing side of the market to fill your order, which makes the price of the commodity move. Okay, so price will, per nature, move through thin liquidity and stop at thick liquidity. So the path of least resistance on this graphic here is up. Okay, the path of most resistance is below it right here. So price is going to have a tough time moving through these here. But on the other hand, you buy, and we're going to move up in very short order. Okay, let's have a quick look at another representation of this where you have the same thing. So you have, this is liquidity above and below price. This is the open of a period, and this is a close. So price opens. So what happens? Well, the first thing that happens is price is looking for liquidity. And this searching of liquidity will simply cause price to move up and to move down. So if you look at a price chart, very, very early Asia, what's going on? Well, it's not really moving. And that's because no one's looking to buy and no one's looking to sell. The markets are closed, and so nothing happens. So price almost stops moving. Then the markets open, the banks open, they look at their order books, they start looking to fill orders, and this attempt at filling orders, advertising these price points, will start to get price to move. Okay, because if price needs to go up, then we have to find willing buyers below price. So, the day opens, price goes down, we start advertising cheap prices, we start getting closer where people are looking to buy. What happens? We start to move higher. We find an opposing side of the market, we start to fill, we fill maybe a portion of that pending up here, and that causes price to go down. And the process will go on and on and on and on. Okay, but eventually, because we have thin liquidity here and thick liquidity here, just like we saw on the previous slide, price will have an easier time moving higher than it will lower, because we'll need to see much heavier selling to consume this than we will buying to move through here. So the path of least resistance is to move higher. So if we look at this on a price chart, so you can see here pretty clearly we have prices move down, and now we're moving higher. And so just note for a second, if we focus on this little tiny window just here, notice here that we have prices moving sideways. We're kind of moving sideways like that. So this is an upward sloping channel, and so price is doing the same thing. Okay, we're trying to find sellers. We found some. We started trying to find buyers. We found a little bit. Advertising buyers, sellers. Okay, we're looking for buyers. We found. And nothing's really going. This is maybe at night. Nothing's going on. We have these tight ranges, and we find some buying. We have maybe someone does something up here, drives price to the opposite side, and we come back up, and we start to move down. We're advertising cheap prices. We find buyers, and now we're kind of sitting around here. It's early Asia here, and so there's still not a whole lot going on. So price is kind of just moving around, not really doing a whole lot. Okay, so this is super interesting, and this is exactly what you can see when we look at something like this. Price is simply looking for liquidity to drive price either higher or lower. When you see price doing this at historically respected areas, the historically respected area is this area of supply, and this area of supply is supply because last time it was here we formed this area of supply. This is supply because we had market structure, it failed, this area did it, so we killed this, we moved below here. Okay, so this qualifies, this is supply. Price comes down. On the way we form this area of supply. It's tested. Okay, price goes through it. This area here is the one that did it. This is tested, and now price goes through it. What area did it? This one did here. This is like the tiny little micro area that did it here. See, this one closed through it. Price came up, tested, and then we went down. But notice here that price tested it once. We continue this out. Tested it once here. Now price rallied into it, accumulated, and we popped through it. So what area did that was something in here did. We have a lot of areas of micro demand in here. We have this one here. We have this one here. Price gapped up, so you've got this one just here. This one here is the one that's responsible for moving this. So the area of demand is around here. Okay, so price popped up, we pulled the slingshot back, and then we rose north. And so currently we are looking at this area here. So we're trying to advertise higher prices to get people to begin to sell or to attract breakout traders. And essentially what I like to look at in a situation like this is currency strength. We're looking at a very kind of an extreme area on the market. Okay, so we have an extreme high, we have an extreme low. What happens at extreme highs and extreme lows? Well, price normally leaves them. So we had an extreme high, price left, extreme low, price left. Now we're extreme high. What's going to happen? We don't know yet. But what we do have is we do have insight into the thinnest and the thickest side of the market using currency strength. Price is currently moving up and down. We can't really see where the thin and thick side of the market is. So we need to do like a bit of an x-ray, and this x-ray for me is currency strength. I want to see what the strength of the American dollar is doing in relation to the Canadian dollar. Okay, and you can see here that we had extreme high readings, extreme low readings. What happened historically? Well, price went down. What about here? Price went up. We're up above these readings here. What does that mean? That means we're high, and so we can expect price to wriggle lower. Okay, and this is happening at the extreme areas in the market. I'm not doing this in the middle of thin air. I'm doing it where we have seen the filling of orders historically. Okay, we go to a smaller time frame, we'll probably see divergence. Yeah, so you can see very clearly here that we have, price is going higher pretty forcefully, the price is going lower here. And so the currency strength between these two currencies is shifting. And this is because we're approaching a historically respected area of supply. Okay, and so price is going higher, but the underlying fundamentals, the underlying struggle between these two economies does not completely match what price is doing. And it's a pretty interesting way to look at the market. If we just look at another pair, let's have a look at the Kiwi Japanese yen daily chart. We had extreme readings here in the currency strength, and then price was pushing lower here. We had another kind of a push lower here. We have the lows of this currency strength kind of doing something else. So we form these lows here. You can see the strength of the yen beginning to slowly go down here in the face of a declining Kiwi Japanese yen. What does that mean? Well, that means there's something else going on behind the scenes. This is not really telling the truth. We're advertising cheaper prices to attract buyers, which we saw at demand just here. So price came down. We had another poke. Okay, so price went down. We didn't get the orders filled. We have an order here. The software drew this nicely for us. We had to push into it. We had a deeper push. But notice here that if we go to the 4-hour chart, you can probably see it even clearer. You can see this big push lower. We had a really strong push lower. But you can see the strength of these currencies doesn't support this. Okay, and then you can see also on the daily chart that this is happening at a very extreme price reading. So what can we expect? We can expect price to move higher. So we're trying to get people on board. We're trying to attract sellers by doing this. Breakout traders to go short. Yeah, telling people, yeah, we're advertising cheap prices. We're closing lower. We're going to continue to move lower. But what's the smart money doing? The smart money is beginning to accumulate positions to move in the other direction. So these guys are buying from the retail space who is selling. Okay, and the result is this, what we can see here. We took a trade just here last week based on this very extreme reading. So price popped down here. We popped down into this area, the beginning of the buy zone. The beginning of the buy zone was here. Okay, just here. And the reason I say that is because price left. We had these highs. Price traded above. We pulled the slingshot back down to this area, and then we left. Okay, so this is the most expensive price you want to pay for this at this price point. Price came to it, so we bought around here. Price went up, and we got out around here, around these lows just here. So just around here. Sorry, let me get a different. Just here, and we did this because we were getting out at an area of supply. Okay, and this is an area of supply because when price left here, we managed to do some damage to this. We removed this. The beginning of the buy zone was essentially here. Tested, tested, tested. This one removed it. So we want to be out of the trade when price comes here, because this one is exhibiting strength because it was strong enough to consume opposing demand, which we saw just here. Okay, good. And now notice here that we are kind of doing the same thing again, where we haven't advertised lower prices, but we have a low, we have a higher low, but maybe price is going to have another push lower and move into kind of this territory here. But notice here that we're starting to do this. We don't know what it's going to do yet, so we have to sit on our hands and we have to wait. Okay, but we want to see price advertise these cheap prices, because this is when we're going to start to onboard breakout traders who are expecting price to go lower because we managed to trade below this. Okay, so they'll be selling and we'll be buying from them. Or the institutions, rather, will be buying from us as the retail guys, the stupid guys. Okay, and so this is really interesting. Okay, and you're not seeing this without information like currency strength or or level 2 order books, which the retail space doesn't really have good data for. So it's a very, very interesting discussion and observation. And you can see this also. I mean, typical pushes at extremes. This is an area just here. Price went up, we accumulated, we rallied, we popped up, the slingshot was pulled back, and then we left. So this is the beginning of the sell zone. Okay, but notice when price left, we tried to come back once, twice. So this is the beginning of the sell zone. Initially it's here, then price pokes into it, and we move it up to that area. It goes deeper, it goes to this area. Then price comes up to it again, then we push and we find the thicket of liquidity, which is up here, and then we leave. But notice here that if we look on this time frame as well, so we have strong pushes in price, but we have a different story being told on the strength of these two currencies. You can see that the price of the Kiwi, Japanese yen, is going up, but notice the strength between these two currencies is doing something else. It's going down. Okay, so we have price going up, but the strength is going down, essentially telling us that the yen is gaining in strength in relation to the Kiwi. And so what does this tell us? That tells us that there's a probability that we're going to see price turn around in this area. Okay, and we can say this because we are doing business at supply. So we know that we have people looking to sell at this historical level, so we know that. We can also see that we are seeing false advertisements for higher prices at supply, combined with competing currencies here, where you see the Kiwi slowly beginning to lose the battle. You can see here that, I mean, the yen is slowly moving higher, and the Kiwi is slowly moving lower. And so we're doing business at extreme price levels at areas where we can see these patterns emerging, and they work very well.